Hello, everyone, and welcome back to a brand new episode of Tax Thursday brought to you by Smart Counsel. I am your host, DDQ, here with Smart Counsel's tax resident attorney, Miss Dionne Kellier. Happy Tax Thursday,
Tax
Dionne.
Thursday, Dee.
Awesome. After this episode, make sure you make your way over to the Smart Counsel website at www.smart-counsel.com to learn more about this minority and woman-owned firm. There you will learn more about each attorney and their practice areas. Inflation. I'm sure you have heard or seen the word either on the news or social media. Do you ever wonder how this will affect you come 2023? Which is crazy to think that that's only 2 months away from now, it being the first week of November. But in today's episode, we're actually going to talk about that, how that affects you as a taxpayer, as a U.S. citizen. So I guess we'll start with the basics. What exactly is inflation?
Okay, so inflation measures how quickly the prices consumers pay for a broad range of goods and services are rising. So the IRS released dozens of inflation adjustments affecting individual income tax brackets, deductions, and credits for 2023. And it was a bit hotter than expected in September, with monthly gains fueled primarily by housing, food, medical care, the U.S. Bureau of Labor Statistics said. So let's just talk about what inflation has done over, let's say, in September 2022. The cost of food at work or school has risen by 91.4%. Airfare has risen by 42.9%. Utilities, gas is risen by 33%. Butter and margarine by 32%. I did read somewhere that there was supposed to be a butter shortage. I don't know why, but we see it's risen by 32%. Eggs by almost 31%. Health insurance, 28%. Public transportation, 27%. Energy overall has risen by 19.8%. Gas of all types, 18%. Chicken or poultry, 17.2%. Electricity, 15%. Milk, 15%. And in all of this, while the prices of these things have risen, it's not saying that income is rising. It's not saying that people are making more money. These things are just rising. So the IRS is trying to make the adjustments so that it doesn't appear that you're making more money because, there's just all of these, there's just everything is rising. The only thing that has dropped is televisions. The purchase of televisions have dropped by almost 18%, and smartphones have dropped by 21%. And everything else has basically risen.
Interesting. I mean, even as a consumer myself, I've definitely seen those prices at the grocery store go up. But I just, the other day I went shopping, I grabbed like maybe 2 boxes of cereal and a few things, and they came out to like $115.
Yes. Have you seen chicken wings? Oh my gosh, they're like $30. You might as well go to somewhere and get freshly cooked chicken wings, and it's going to be cheaper than going to the grocery store.
For sure. Yeah. So the only thing that's really decreased is the purchase of televisions and smartphones.
And that's only in September, right? Because I'm pretty sure that everybody bought their new televisions and smartphones last year, right? Or when COVID first started, when you had to like work from home and you had to make sure you were on top of technology.
That's a good point. Yeah, definitely. So this is compared to last year, September 2022 to 2021.
Yes, same time last year.
Awesome. Okay, cool. And so now you're saying that the IRS is keeping in mind that even though all of this is rising, our income is not
exactly
rising.
So the IRS, the individual federal tax brackets have been automatically indexed for inflation since 1985. It was a provision that was passed in 1981 after a period of inflation even higher than what the country is experiencing now. Luckily, I wasn't born yet, so I didn't experience it. The point of adjustments is to make sure that people aren't artificially pushed into a higher tax bracket by inflation. And those whose income hasn't increased with inflation could end up paying taxes at a lower rate in 2023 than in 2022. So you could get a tax cut that makes up for some of what you lost. And the well-paid could also give themselves a tax cut by increasing the amount they contribute pre-tax to retirement accounts. The maximum 401k amounts, the contribution amounts are going to increase, and as well for normal people and then those above 50. But we'll talk about that. We'll get into the specifics right now. So the standard deduction that's now claimed instead of itemized deduction, the standard deduction is claimed by more than 85% of taxpayers. So when you have a standard deduction, the IRS basically doesn't question that amount. So you have your taxable income, and then you have your adjustments to it, then you have whatever your adjusted gross income would be, and then that adjusted gross income is what would be taxed. And so when you have, then that adjusted gross income is then lessened by either your itemized deduction or your standard deduction to give you what your taxable amount would be. So as an example, if you make $100 and you're single and the standard deduction is $50, then as a single person, you pay tax out of your W-2 check on your $100, right? But then if you have a standard deduction of $50, you've already overpaid taxes, right? Because you're paying on 100, but you've already been allowed to deduct 50. So that's kind of like how the standard deduction works. Right, where itemized deductions, you have to have proof. I would say permanent proof, because we know with the IRS, the onus is always on the taxpayer to prove their way out of what the IRS alleges. So for married couples filing a joint tax return, the standard deduction is going to jump from $25,900 to $27,700. I mean, that's a pretty big jump, because in when tax reform happened, I want to say that the standard deduction was like $25,000. So it's like almost a $2,500 increase. Yeah. And even so, now for singles and couples filing separately, or it will rise to $13,850 from $12,950. But when in tax year 2018, I want to say it was $12,000 standard deduction. So, or tax year 2018, it was $12,000. So it's jumped up very significantly. For head of household, it's going to rise to $20,800 from $19,400. And a head of household is a single adult with dependents such as children. And the additional standard deduction for someone who is 65 or older will rise to $1,500 per person from $1,400. And if that senior is unmarried, then it'll go up to $1,850 from $1,750. The individual tax brackets for ordinary income as well as for capital gains will be jumping in 2023 by 7%. So, for example, the lowest 10% ordinary income tax bracket will cover the first $22,000 of taxable income for a married couple filing jointly, up from $20,550. I'm going to explain that when we go into the brackets, because basically what that is saying is that if you make a certain amount of money, you're going to pay this amount in taxes. And then when you get to the next tax bracket, you're going to pay what you would have paid in the previous tax bracket. And then anything over it, you're going to pay an additional amount. So that's why they say, oh, you're going to pay, you're going to pay $20,000 plus whatever. But we'll get into that. I feel like an example is going to be better understanding versus them just giving you the number saying that you're paying 24%, right? But the IRS likes to make things complicated. So let's see. So young workers. So for the 401k, you can now contribute $22,500 in 2023 as opposed to the $20,500, and those that are 50 or older will be permitted to do $30,000, which is a $3,000 boost, which includes a $7,500 catch-up contribution from the $6,500 catch-up contribution that you could have done in 2022. And that means employees who are already contributing the maximum are able to save more, will be in effect cutting taxes for themselves. And the IRS limit for pre-tax contributions to an IRA or a Roth IRA will rise to $6,500 as opposed to the $6,000, which it's been at for the last 4 years. And those that are 50 or older can make an additional $1,000 contribution. And the maximum contribution an employee can make to a simple IRA plan, it's a retirement plan designed for small businesses, will rise to $15,500, up from $14,000. And the contribution limit increases are widely anticipated since they are based on the inflation rate, which is now running at a 40-year high.
Wow. Yeah, I think definitely an example would help really simplify that, if that makes sense. It is a lot of numbers thrown at.
So let's do, for instance, a married filing jointly person. If they make, actually, let me do single, right? Because single is, we're going to do single and then we're going to do married filing jointly so you can see the single penalty, even though they say that there's a marriage penalty, but I really think it's a single penalty. All right.
Interesting.
So if you make between $0 and $11,000 as a single person, then 10% of you're going to pay 10% on taxes on your income, right? On your taxable income, right? But if you are married filing jointly, if you make 22,000, then 10% of that is taxable, right? So it's doubles.
Right. Yeah, I was gonna say, so it's almost doubling.
But then if you make between 11,000, now we're going back to single. If you make between 11,000 and 44,725, you're going to pay 1,100 in taxes, which is, if you made that 11,000, 10% of 11,000 is 1,100, right? And plus 12% of the amount over 11,000. So it's basically you're paying 12% taxes on your entire income, which it equals the same thing. So, right? So if we do the number right now, if we do 12,000, we're going to use the biggest number that they have, 44,725 times 12% equals 5367, right? Okay. And if you do it the way that they say, 1,100 plus 12% of the amount over 44,725. So 44,725 minus 1,100, minus 11,000 is 33,725. We're going to multiply that by 12%. And that gives you 4,047. And then you're going to add 1,100 to that. And it gives you 5,147, which actually it is, right? Did I do the right number? It's 1,100. Wait, hold on. 44,725 minus 11,000, right? Equals 33,725. 12% is 4,047. Yeah. All right. Well, yeah. Well, I guess it works out a little bit, a couple $100 cheaper. Right. Plus 10%.
And this is for single, right?
Single.
The math that you're doing.
So 10%. So 1,100. So it's actually, when you do it this way, it works out a little bit. It's like a couple $100, $200 difference, but it really all works out in the end. So anything over what you paid in the last tax bracket is you're going to pay what you would have paid in the last tax bracket plus the amount that's over the cutoff in the last tax bracket. That'll be your tax rate. That's why you have an effective tax rate, and everybody doesn't just fit into a box, right? So.
Right. And is this like a way to kind of help taxpayers?
It's supposed to help taxpayers. So if you can contribute more to your retirement plans, that helps you because it takes out, that's pre-tax money. But, where it doesn't necessarily help is because inflation is rising, but it's not saying that income is rising. So you can still be making the same amount of income, and with the cost of everything rising, and they're just trying to adjust it so that it's not as if you're, it's kind of, I guess it's supposed to be adjusting for your income not rising.
Interesting. Right. So like in the end, you would owe less taxes to the IRS or get like a bigger refund?
Well, you're going to owe less taxes, but you still have less money to play with because everything costs more.
Right. So much, right.
Exactly. So it doesn't, in the end, does it really work out? I don't necessarily think, I don't think that the taxpayers are getting any benefit out of it. Yeah. So that's that's my personal opinion. So let's go to, like, for instance, Social Security benefits, they are not affected by inflation. And so one key item that isn't indexed is the income levels at which the Social Security benefits kick in. So that means that more moderate income retirees will be paying federal taxes on their 2023 benefits, which it would be boosted by an 8.7% cost of living adjustment. They call that COLA. So like if you work for the government, every year they do a cost of living adjustment. But my understanding is that it's only like at a 3 or 4% adjustment, whereas the cost of living has risen by almost 9%.
So much.
So we're already kind of behind. The tax rate for qualified stock dividends and long-term capital gains for a married couple, they won't owe anything until their income is above $89,250. And then above that, the gains rate is 15%. And the top gains rate of 20% will kick in for a married couple when they make $553,000, and in 2022 was $517,000. For individual filers or single people, the 15% capital gains and dividends tax rate kicks in on income above $44,000 in 2023, where it was $41,000 in 2022. And the dividends tax rate and the capital gains tax rate is either 0%, 15%, or 20%. It's also called preferential tax treatment. That's what everybody wants because the highest regular rate is 37%. But there is a benefit for single people. The top 20% tax rate won't hit until their income exceeds $492,300. That's up from $459,760. So, you actually do get a big benefit if you're a single person and you have, all of this disposable income. But, I'm pretty sure that you having to buy all your stuff yourself. I can understand that.
How rare is that?
I gotta pay for my gas and I gotta pay for my food. I'm not sharing that with anybody.
Right.
So I guess that
rent.
Yeah.
Too.
Oh, please. Rent, gas, health insurance. All of that stuff. Let's see the maximum. Oh, but there's something that is the key credits. They get adjusted. So the earned income tax credit for qualifying taxpayers with 3 or more children will now be $7,430, up from $6,935. And let's see, for a married couple, their earned income tax credit will phase out when they start making above $28,000, but they won't lose the credit until their income hits $63,000. So that's like a $43,000 difference. But a two income household that's making $63,000. Rent in most places is like above $2,000. So let's just say that's $48,000 a year for possibly a 2-bedroom. Definitely not here, not in Fort Lauderdale will that happen.
Right. It's definitely rare out there. That's kind of like the situation that me and my husband are in, like trying to find a reasonable home for no more than $2,000, but it's impossible.
Yeah, and especially so your issue, right, is going to be twofold. Number one, housing prices are skyrocketing, although it's going to level out. But number two, you're in a place where there are a lot of cash buyers their number between like 250. I got soap in my eyes, so that's why it's leaking. Sorry, but for between cash buyers that have between like 250 and 400,000 are always going to beat you out, right? Because they have access to that because Colorado is a cash heavy place.
Yeah. And it's fun. It's interesting. Just kind of like a side note, I was reading an article about how a lot of people come from out of state and buy property, but use it for Airbnb.
Yes.
And not a lot of people are traveling or doing Airbnb anymore. So then there's just like empty houses just sitting there that could be bought by like residents of the state for their actual home.
I saw that, right? And I also saw that in Georgia, they're only limiting you to own one property that you live in and have an Airbnb, right? Because Airbnbs were like the hot thing, and especially during COVID times. And, like hotels are good for certain things, and Airbnbs, I guess, are good for certain things. Because like when we go to Tennessee, we don't stay in a hotel. When we go to Gatlinburg, we stay in an Airbnb. But I'm also going with my entire family that's going to cook and do all that kind of stuff. Like, if I go, do I want to cook? No. Do I want to clean? I don't. I just want to wake up and go.
Right, exactly. Very interesting that Georgia's doing that.
And I think a lot of other places are going to do it as well. And but also with the Airbnbs, people have figured out the cheat code to it. So there was a lot of people, they're not owning the properties, they're renting the properties, and then they're doing an Airbnb. So they don't have a mortgage cost, they don't have any insurance, they don't have anything, but they're making money. But when the owner or the building or whatever finds out about it, they definitely make adjustments. And I think like a lot of things people got into, now this is going to be my aside, because basically we've talked about the IRS is making adjustments for inflation, and so everything should catch up, but don't anticipate it, right? But now we're going to talk about kind of like the things that were happening, like NFTs. I saw an article that and this is going to be something that's going to be big coming up, is that they're saying that the NFTs were basically like a Ponzi scheme, because
Oh no.
there is no way, there is no independent third party valuation of an NFT. Just what
Interesting.
people say that it is. Listen, I bought Dogecoin, right? I saw those little kids getting rich. Like, why wouldn't I? And I know that they're coming up in a lawsuit, but I took the risk. But I'm, also older, so I understand that certain risks you take,
Right.
then you just kind of have to eat whatever happens. Like, who is valuing Dogecoin?
Right. Right. That's always been like my big question on NFTs and all that stuff. Even like Bitcoin and all that fun stuff. It's just like who really says, like someone just kind of creates something and just lets them know like this is how much this is worth, and now you can trade or sell or buy. So it's always very interesting that. So now it's coming out that it's a
Yeah,
Ponzi scheme.
it's going, we're gonna keep on getting information about that, right? Because now NFTs got really big last year, which is this
Yeah.
tax year, right? So that means that people filed their taxes and the IRS is auditing them, and now they're going to get these notices of deficiency, because the IRS for sure is going to use the highest valuation on a sale for the gains, and then they're going to use the lowest valuation on the losses. And most people that were doing NFTs and Bitcoins and crypto overall, they didn't have any formal way of doing valuations. It's at the end of the day, it's what somebody says. And I'll say this: listen, if Bitcoin goes, into those 3-digit below the 4-digit numbers, 5-digit numbers, I ain't definitely gonna buy it, right? Because I'll take that risk, but I wouldn't utilize it to offset any losses that I have, because I feel like everything is so subjective. And we know that Elon Musk, in not Twitter CEO Elon Musk, but before that, anything that he said about Dogecoin and Bitcoin really affected the market. And was that purposefully? Are we going to be watching American Greed in a couple of years and see that, all these things are tied together? We're in a very interesting time.
Definitely. We definitely are. There's so much happening I think just the whole inflation stuff, like just kind of going back to that, is like a scary thing for most Americans, and with the rise of the income not rising, but everything else is getting so expensive. What does that mean for us as, citizens of the world,
I'm playing lottery for sure, right? Because, that's my thing. But I think, what I really think? I think that, while I'm not an economist or anything like that, I feel like when we started to get these stimulus checks in 2020, right?
Mm-hmm.
When we were already working at a deficit, where was this money coming from? And then there was 3 different checks. And then there was the PPP loans, and then there was, and then most of them are forgiven. And then there were just all of these things that were needed at the time because we didn't know what was going on. But at the end of the day, everything, the rubber has to meet the road, right? At the end of the day, the money has to come from somewhere. And if it's coming from somewhere and it's not being replenished, something has to happen. All of these inflation rate hikes that have happened in the last 3 months, it's to be expected, because you have to they have to make this money back up. And
right. And that's with the United States being in debt themselves, right? Our country being in so much debt.
And if China ever called in their debt that we owe them, I mean, that's why politically everything is always so sensitive, right? Because you would think, China did this, you should XYZ. Not so fast, because China, we owe China a lot of money.
For sure, right. And what does that mean? We owe them money. Okay, so where's that money? Is that expected from us as taxpayers? Is that because the war? COVID take into consideration?
Everything. Like if
Yeah.
the paper money doesn't have the value that it had before, because what is backing it?
Right.
If debt is backing paper money, then what does the paper money mean?
Exactly. And I have read that, that the US dollar is starting to lose its value because of that. We're just kind of like just printing money
That's exactly what we're doing.
without any value
That's
behind
how we
it.
have these stimulus
Yeah.
checks. Up, we don't have any money. Up, we're $3 trillion in debt. Everybody gets a check. Okay.
Right. And not just one, but you got 3
Yeah,
checks.
and then wait, did you see? And I didn't even get into it, but did you see? Is the government cutting checks for the loan forgiveness, as opposed?
I I was looking into that too because I've had a lot of people like, do this, do that, get your loan forgiveness. And I'm like, wait a minute. Wait, am I going to get like money coming towards me now?
But they
Like,
paid it directly. I thought they just forgave it. Wait, are they sending
yeah,
me the $10,000 check for me to pay it? I mean, we know how that's gonna
makes
work
no
out
sense.
for most people. They're definitely, yeah.
Right.
But then what the government could do, which I anticipate them doing, if they are cutting you a check, I anticipate in like a couple more months that they're gonna ask for proof that the check went to pay your loan.
Oh, right. And that's where a lot of people will probably get in
But they're not
trouble.
thinking that far ahead. So, as most people don't.
Right.
So
I just wonder why they would go about it that way instead of, like you said, just like forgiving it instead of like, here, let me give you money so that you can pay us
I
back.
feel like, you know what? I feel, and that is a very interesting. I feel like it's a setup, because
Yeah.
then when you get the check and you don't pay the fee, or you can't show that you paid your student loan, then not only do you owe the $10,000, but you owe the penalties and the interest on top of that. So maybe they do know what they're doing.
Right.
So,
Right. Just trying to play like this little trick on
exactly.
us.
So I don't know. I mean, only time will tell. So yeah. So okay. So to circle back to our topic, right? So it was Revenue Procedure 2022-38 that made these adjustments for inflation, and some of the highlights, which are not going to be there. It's going to apply for year 2023, tax year 2023, but you're not going to see any of these benefits until actual year 2024, because that's when you file your 2023 tax returns. And
Right.
so let's see, the standard deduction, it rises for everybody for married couples filing jointly, it rises to $27,700. For single and married filing separately, it rises to $13,850. And for head of households, it rises to $20,800. The top tax rate still remains $37,000 for single taxpayers that make $578,000, and for married filing jointly $693,000, and do above that. Let's see, the tax rates still stay the same, so it's going to be 12%, 22%, 10%, 12%, 22, 24, 35, 24, 32, 35, and 37. So there's 7 tax rates. That's the ordinary tax rates, ordinary income tax rates, or if you have a short-term capital gain, highest rate 37%, lowest rate 10%. If you have dividends, highest rate 20%, lowest rate 0%. What else? The earned income tax credit is $7,430. It's rising to that amount. The monthly limitation for transportation fringe benefit, it increases to $300. The dollar limitation, I know I should have hid my face, because it's like things like that, because guess what is not on my list? The teacher, you remember how the benefits for the teachers, the $250 that they get to luckily deduct, that didn't rise, right? And we know that they're paying for most things themselves. For tax year 2023, the dollar limitation for employee salary deductions for contributions to HSA accounts increases to $3,050. If you have self-only coverage in a medical savings account, the plan must have an annual deductible that is not less than $2,650, but not more than $3,950. The foreign earned income tax exclusion is $120,000, which is up from $112,000. Estates of decedents who died during 2023 and have a the basic exclusion for what you could have in your taxable income is going to rise to $12,920 as opposed to the 12 million, 12.9 million in 2023 as opposed to the 12.06 million. The annual gift exclusion in 2023 will increase to 17,000 per. So 17,000. So each person is allowed to gift 17,000 to as many people as they want, and that amount will be deducted from their taxable estate when they pass. The maximum adoption credit rises to 15,950. It's up from 14,890. But if you've ever talked to anybody who's done an adoption, it's like the adoptions cost like $60,000, $70,000, $80,000, $90,000. So, you know.
Right.
And the items that are unaffected by inflation is the personal exemption is still zero because that got cut by the 2017 tax reform. And there is no limitation for itemized deduction. And the modified adjusted gross income amount used by joint filers to determine the reduction in lifetime learning credit is not adjusted for inflation. So if you make more than $80,000 as a single person or $160,000 for married filing jointly, then you are not allowed to get the lifetime learning credit.
Wow. Wow. Okay. So yeah, that's a lot of information kind of thrown at us as taxpayers. But what would you say is the biggest takeaway from this topic?
The biggest takeaway is that the standard deduction increases, and if you're married filing jointly, you probably don't even need to itemize because having $26,000 or $27,000 of standard deduction without having to prove anything to the IRS, I mean, I feel like that's pretty good. Let's see, you're able to contribute more to a 401k or IRA or a Roth IRA. And, you know, I would say that everybody should have a game plan for when anybody under 50 should have a game plan for when they're going to retire, because the way that it's looking right now, any government subsidies are not going to be available by the time we retire.
Yeah, I've kind of read a lot that even if you do retire, you still need to have some kind of income coming in to pay for everything that is so expensive.
Exactly. And the final thing that I want to say is that, okay, so the Roth, the traditional IRA that takes pre-tax money, you have to pay the taxes on it when it's distributed to you, and you have to start taking the distributions at like 65, maybe 67, right? So the thought behind it is that when you get to that age, your income bracket, your tax bracket is going to be less than what it is in your younger years when you're doing a lot of earning. But I see that that's not the reality.
Right. So when so then you would have to pay taxes on all of that you
more taxes than you're probably paying when you're in your 40s. And you're working, then when you get to your 60s or 70s and you can't work, I feel like your tax rate is going to be higher, and most people don't account for that. And, you know, I do tax resolution, but there's nothing that I can do about your tax rate.
Right. Do you see that changing in the future?
I think that it's only going to get worse. I really think that I feel like accountability is no longer, here. And I feel like there's going to be a lot of companies that go bankrupt, and that a lot of the things that you put your money into that you thought were going to pay you out in 40 years, they might not be around.
Oh, man. Interesting. I'm interested to see how that will play out, honestly.
I agree with you.
Well, I guess another thing, just kind of thinking about inflation and stuff, that's with things rising. What happens when things start to crash?
Well, what's going to crash? Well, what's not going to crash is the cost of living.
Yeah. So. Yeah. Oh, man. Well, I guess we'll just have to hang tight and see what's going on and just kind of prepare, because like you said, we're not going to see this until we are filing taxes in 2024 for the year 2023.
Exactly. So let's see how it plays out, and let's see where we are in 2023.
Yeah, definitely. 2 months,
Yeah.
guys. 2 months before we get to that year. But awesome, Dionne. Thank you so much for your expertise and knowledge on this
Thank
topic.
you.
It's something that a lot of people have questions on, but I don't think we know what questions to even
Right.
ask, and how this is going to affect us. And I don't think people think about the tax portion of it. It's more of just like, how am I going to afford to live, and how am I going to afford to
Right.
eat, or raise my kids or anything like that. So if you guys do have any further questions for us, particularly Dionne, please shoot us a comment down below or DM us on Instagram. You can always email us at attorney@smart-counsel.com. If you have a topic that you want to see us discuss on here, always send that our way. But otherwise, make sure you're following us on all of our social media platforms, that you like and subscribe to our YouTube channel so you don't miss out on any future Tax Thursday topics. Again, thank you so much, Dionne. We will see you guys all
Thank
next
you,
week.
Dee Dee. Have a wonderful day.
You too. Bye.